Most people think that to be a successful investor you have to be a genius, a math whiz, or a wolf on a trading floor. They think you need to spend your life staring at flickering green and red numbers on a screen. I used to think that too, but after 60 years of watching the world turn, I've learned that the most powerful way to build wealth is actually the most boring way. Today I'm going to explain index funds to you, not like a salesman, but like a neighbor who wants to see you retire well. When I was in my early 30s, I met a man who swore he had a system. He spent hours every night researching individual companies, trying to find the next big winner. He'd buy a tech stock one week and a mining company the next. He was always stressed, always checking the paper, always convinced he was one tip away from a fortune. I tried to follow him for a while. I bought a few individual stocks, and I'll tell you, I didn't sleep a wink. When the company did well, I worried about when to sell. When it did poorly, I worried I'd lose everything. One day an old mentor of mine sat me down and asked, "Why are you trying to find the needle in the haystack when you can just buy the whole haystack?" He introduced me to the idea of an index fund. He told me that instead of betting on a single horse, I could bet on the entire track. That was the moment I stopped trading and started investing. It turned my financial life from a chaotic storm into a steady, quiet garden that just grew. The problem with traditional investing is the ego trap. We are told that we or some expensive fund manager in a suit can outsmart the collective wisdom of the entire world. But the data tells a different story. According to many long-term studies, the vast majority of professional money managers fail to beat the average return of the market over long periods. If the people with the fastest computers and the most expensive degrees can't consistently beat the market, why should you and I try? The real secret isn't beating the market, it's matching the market, and doing it for as little cost as possible. Index funds are the tool that lets you do exactly that. Imagine you want to buy fruit. You could spend all day trying to pick the perfect apple, hoping it's not rotten inside, or you could buy a pre-packaged basket that contains a little bit of every fruit in the store. An index fund is a basket of hundreds or even thousands of different stocks. An S&P 500 index fund is simply a basket that holds the 500 largest companies in the United States. When you buy one share of that fund, you own a tiny piece of Apple, a tiny piece of Microsoft, a tiny piece of Amazon, and hundreds of others. Think of an index fund as instant diversification. Instead of your fortune depending on one company, it depends on the health of the entire economy. If one company in the basket fails, there are hundreds of others to pick up the slack. This is the part people often miss. In the world of investing, you don't get what you pay for. Fees are the termites of your retirement. Some actively managed funds charge you 1 or 2% a year just to manage your money. An index fund might charge you 0.03%. That sounds like a small difference, but over 30 years that 1% fee can eat up a third of your total wealth. When looking at funds, look for the expense ratio. Anything below 0.10% is generally considered very low. Every dollar you don't pay in fees is a dollar that stays in your account, compounding for your future. The biggest enemy of a good investor is the person they see in the mirror. We are wired to react to fear and greed. Your greatest asset isn't your brain, it's your temperament. When the news says the market is crashing, most people want to sell. When you own an index fund, you realize that you aren't just holding stocks, you are holding the productive capacity of the human race. Unless you think the entire world economy is going to zero and staying there forever, there is no reason to sell. Automate your investment. Set up a monthly transfer from your bank to your index fund. Don't look at the balance every day. Check it once a year. The less you do, the more you often make. I've seen the math work its miracle over and over again. Compounding is a slow burn that turns into a wildfire. Time is the multiplier. If you invest $500 a month in an index fund that returns an average of 7% a year, after 10 years you have about $86,000. Not bad. But after 30 years you have over $600,000. Most of that growth happens in the final few years. Start now, don't wait until you have more money. The time you have left is more valuable than the amount you have today. A single dollar invested in your 20s is worth more than $10 invested in your 50s. As you start, people will try to sell you themed funds, AI funds, green energy funds, crypto funds. Be careful, simple is better than clever. A total stock market index fund covers everything: tech, retail, energy, healthcare. It doesn't try to guess which sector will win this year. It just owns it all. For most beginners, a total stock market or S&P 500 index fund is all you ever need. You don't need to be a sector picker. By owning the whole market, you are guaranteed to own the winners whenever and wherever they emerge. If you're ready to start, here is your simple, no-hype checklist. Pay off high-interest debt and build a small emergency fund first. Open an account at a reputable, low-cost brokerage. Choose a broad market or S&P 500 index fund with a low expense ratio. Choose an amount you can afford to leave invested for the next 10 years. Automate it so the money leaves your account the day after you get paid. Turn on automatic dividend reinvestment so your seeds plant themselves. Ignore the financial news, they are paid to make you feel panicked. When the market goes down, and it will, view it as a sale where you are buying more shares for the same price. I hear the skeptics, they say, isn't the market at an all-time high right now? Shouldn't I wait for a dip? The market is often at an all-time high because the economy grows over time. If you wait for a dip, you might miss out on a 20% gain while waiting for a 10% drop. You can't time the wind, just set your sails. Others say, it's too boring, I want to find the next big thing. Investing should be like watching paint dry or grass grow. If you want excitement, go to the casino or take up skydiving. Your retirement fund is for security, not for adrenaline. And some say, what if the whole market crashes and never recovers? If the entire global stock market crashes and stays at zero forever, we have much bigger problems than our brokerage accounts. At that point, money wouldn't be worth anything anyway. Betting on the index is betting on human ingenuity. So far, that's been a winning bet for centuries. This is for education. I'm not promoting any platform or guaranteeing results. Investing involves risk, and you can lose money. Consider talking to a qualified professional who can look at your specific situation. You don't need a miracle to be wealthy. You just need a plan, a little bit of discipline, and a lot of time. Index funds are the bridge that gets you from where you are to where you want to be. What's the biggest thing holding you back from starting your first investment? Is it fear, or is it just not knowing where to click? If you like this kind of slow and steady talk, consider subscribing. We're building a community of people who value peace over hype. Take care.